What is a corporate rider? A corporate rider is an investor who buys a large number of shares in a corporation whose assets appear to be undervalued. The large share purchase would give the corporate rider significant voting rights, which could then be used to push changes in the company's leadership and management. This would increase share value and thus generate a massive return for the rider. Understanding corporate riders may use a variety of tactics to affect the changes they desire. This can include using their voting power to install hand-picked members to the board of directors. They could also buy the outstanding shares under the pretense of pushing for changes the current leadership is not amenable to, but then offer to sell back those shares at a premium price in order to return a profit for themselves. A corporate rider might want to see certain assets and business lines divested from the company, possibly to unlock the value of the assets or to remove a detriment to the company's bottom line. That could include eliminating offices and production facilities that are costly to maintain. A corporate rider may simply want to reduce the headcount of a company as a means to increase its profitability, which in turn could be a step towards preparing the company for a sale. The main motive behind the corporate rider is to generate an attractive return for their investment. As such, corporate riders scout for companies that are deemed undervalued. Identifying an undervalued company requires a deep understanding of, among other things, a company's current financial position, the management's competence, business model, and future business prospects. A starting point to identifying an undervalued company can be through a stock screener and looking for companies that are trading at a low valuation multiple comparative. For example, an investor can use a stock screener to identify companies that are trading at a lower price to book multiple and enterprise value to a EBITDA multiple to peers. For example, an investor can use a stock screener to identify companies that are trading at a lower price to book multiple and enterprise value. All else equal, if the valuation multiplies of the company in question are materially lower than its peers, it is generally considered undervalued. Thereon, the corporate rider will dive in to analyze the business and its financial statements to determine whether the low valuation multiples are justified. If the corporate rider believes that the company is undervalued, he or she will begin the right process. The most common method that riders use to acquire an undervalued company is by purchasing shares on the open market. Upon acquiring an undervalued company, the corporate rider will attempt to increase the value of the company by replacing its purely performing management, divesting assets, or positioning the business for a sale or merger. An illustration is provided as corporate rider. How it works. According to experts, corporate riders make capital markets more efficient by identifying underperforming companies and improving them. As such, corporate riders are commonly referred to as necessary evil to counterbalance underperforming companies. Common tactics to deter corporate riders. The most common tactics that are used to deter corporate riders includes poison pill, allowing shareholders to buy more shares at a discount to the current market price, golden parachute, a large compensation package guaranteed to company executives upon termination crown jewels defense, selling of company's assets to make the company less attractive, example of a corporate rider. An investor uses a stock screener and identify a company whose market value is trading significantly below its book value. The investor conducts further due diligence, conducting a discounted cash flow and multiple valuation on the company, and concludes that the company should be trading at a significantly higher value. In determining the rationale for the low market value of the company, the investor finds that its historical profitability ratios are comparable to competitors, but that the company's management demonstrates a poor track record in sourcing details to grow the business.